morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you are watching Indian Open. No, not the tennis match. Let's go straight to the headlines. Crisis at Dewan Housing Finance reported a net loss of 2,223 crores for the quarter ended March 2019. The earnings are unreviewed and unaudited. Infosys raised its revenue growth guidance for FY20 from a band of 8.5% to 10% from a band of 7.5 to 9.5% earlier. First quarter earnings were in line with estimates. India's consumer price inflation rose to an 8-month high of 3.18% in June, while industrial production grew 3.1% in May. In sports updates, England beat New Zealand in a super over at Lord's to lift the Men's Cricket World Cup. And Novak Djokovic beat Roger Federer in a 5-set thriller to win his 5th Wimbledon title. I must say the argument about the greatest of all times will now take a twist. Federer on 20 Grand Slam titles, Nadal on 18, Djokovic on 16. Much younger Djokovic. Let's wait and watch who ends with the most when they hang up their boots. Anyways, let's take a look at the markets, really a super sports Sunday, but let's put that behind us because equity markets beckon. Just a bit of a recap. I think the US markets had a fairly interesting week. You could argue that the percentage gains may not have been as great, but Friday was decent. So it ended the week on a very good note, record-breaking levels for all of the indices. S&P above 3,000, Dow Jones above 27,000. Nasdaq has been doing well the last few days as well. So it was a pretty interesting week for the US equity markets, and that should keep the other markets in ship-shape. By the way, keep in mind the dollar index, and that gives some cues for what could happen to the emerging market pack as well, because the dollar index is consistently showing some signs of a downtick. And that should augur well if you're an Indian market watcher, to be honest. So no complaints on that front as well. And if you look at the rest of the Asian screen, it's all over the place. But SGX Nifty indicates a start which is marginally in the green. So Hang Seng and Shanghai marginally in the red, about 0.5% or thereabouts. But the SGX Nifty indicating a start which could be marginally in the green. So I don't think an Indian market watcher should be complaining Monday morning. But yeah, the last week was not the best. It was the worst week since the May for the Nifty. The buyback tax, surcharges, all of that dampened sentiment. You could look at it from a perspective of what's happened across the fund flow situation as well. That was evident that the FIs would have been disappointed. Look at the yields and the currency. The yields continue to come off. So the bond markets are continuing to do well. Even the equity markets aren't, because at 6.48, they have come off quite rapidly from the October levels of about 8.20. So it's almost 170 basis points pull back in the yields since October 2018. So the world markets or the world central banks are looking dovish. I don't think that Indian bond markets are pricing anything less from the Indian central bank as well. So equity markets may not be looking as great. Bond markets are looking fine. It's a very interesting week for equity markets simply because a bunch of very important numbers come out. The biggies like HDFC Bank and Reliance come towards the fag end of the week. But from a financials perspective, I think it's a really important week because remember, rate sensitives are starting to participate pricing in the rate cut. Look at the numbers this week. A lot of important mid caps, not necessarily just the large caps. So DCB, Federal Bank, Yes Bank comes out with its numbers. You have RBL Bank, HDFC Asset Management, and then on Saturday you have HDFC Bank, the big boy, coming out with numbers. So a very interesting week if you are indeed watching the banks. And not necessarily just the bank Nifty, but the entire space at large. This week will tell us how the Indian banks have performed in Q4 when the slowdown was clearly evident. But as I said, if you just look at what the action from the institutions is, it's not the most impressive. Spooked, no doubt, by these tax changes, FIs have continued to sell. And in Friday's session too, it was a fairly large sell number, 850 crores. This is amongst the larger ones that I've seen in some time. And even on the F&O side, FIs have been building in net short positions, so do watch out for that. However, all of this probably point towards some bit of sluggishness in the markets, not necessarily in the near term. In the near term, in today's session, what will work are these 3 or 4 stocks that we need to monitor. So firstly, Infosys, and I think it's a very important stock to monitor. They've raised their FY20 revenue guidance to, as our headline stated, to a band of 8.5 to 10%. Operating margin guidance has been maintained. And if you look at the Infosys ADR, that ended higher in trade in Friday's session, which points towards the stock starting off in the green. The question mark only is, can it do further from there? About 4 or 5% higher for the Infosys ADR. Let's wait and watch what happens to the stock in the session today. Should start off strong. Let's see if we can build on from there. Watch out for Avenue Supermarts. After months and months of people talking about whether there'll be growth or whether it'll face competition, they come out with a quarter which is exceptional. Margins at 10.3%, the highest ever margins, PAT above estimates as well. We'll talk more about this on First Words. I won't dwell too much on this, but yes, a very good set of numbers. It's a stock that's actively tracked by people. Would be interesting to see what happens here. IndusInd Bank, most brokerages have come out with a very positive commentary. May not be too many target price changes, but the commentary on what IndusInd Bank could do as a result of the numbers that have come out, very important. So do watch out for this one as well. And just watch out for two numbers. I won't dwell too much on them, remember, but DHFL, because we'll talk about it extensively. Train wreck of sorts, as Ida tweeted. Let's see what's the reaction on this one. And Sun Pharma, double upgrade by Morgan Stanley. Let's see what the reaction is on that one. So two other names that just squeezing in last minute that I think could be important to monitor. However, let's tell you what's lined up on First Word today. First up, the unaudited results reported by DHFL or Diwan Housing throw up a lot of red flags. Shefali Malik will flag off those concerns. In a battle of the tech titans, who won in the June quarter? Agam Vakil will bring us the scorecard of TCS versus Infosys. Retailer Avenue Supermarts made the most of its everyday low price model. Yatin Mota will get us the numbers. And then the government plans to list at least 10 public sector companies and bring down its stake in a few others. Nikunj Ori will tell us what is on the drawing board. But something that really took center stage in Saturday's session was these numbers that came out with DHFL. Now, the debt-laden company reported a loss of more than 2,000 crores in the fourth quarter. The housing finance company put out its unaudited results, as I said, on Saturday. The question is, did it answer more questions or raise more? Shefali Malik is standing by with all of those details. Shefali, let's start off with the numbers before we get to some of the unanswered questions. How did the reported numbers look?
Well, the numbers were obviously bad, with a loss of about 2,200 crore rupees, and the most important figure in that was the provisioning and the net loss on fair value, which totaled to about 3,280 crore rupees, out of which the fair value loss on wholesale loan portfolio was to the tune of 3,190 crore rupees. So even within that, yesterday I was speaking to an analyst and he said that probably some of these loans have been classified as an investment. So that was his take, because technically speaking, the fair value loss is done on investments. If there are loans, then an expected credit loss, that is provisioning, is done on the same. So I need some clarity on that. Probably I'll be speaking to some accounting guys on that. But the larger picture is that these loans have been marked down by 3,190 crore rupees, which is around 9% of the wholesale loan portfolio. So that is one area which is a question mark again, because on that entire portfolio, it's just a 9% cut, which looks very less, considering there are so many ambiguities regarding, documentation, etc. Other than that, in the earnings, there was a 775 crore rupees deferred tax credit, which provided some bit of relief, but then that again goes to show that the loss could have been much more higher had this not been there. And the loan book stands at about 89,000 crore rupees, and gross NPAs, the reported numbers have spiked to about 2.74%. So those are the earnings which were certainly not good, but I don't think there was anybody who was expecting any sort of miracles to come from DHFL.
No, we weren't, but we weren't expecting too many hollows or too many unanswered questions, because I think the accompanying filings raised some more red flags in the numbers as well, including a note from the regulator.
Yes, absolutely. So the first one, to start with the regulator's note itself. So NHB, in a letter has told them that their capital adequacy ratio, as reported by them, which was 15.29%, should be around 10.24% for the period ending March 2018. So almost a 5% cut on capital adequacy ratio. So the company does not really concur with what NHB is saying. We don't know what observations did NHB make, because we don't have NHB's letter. But this is as per reported by the company, that NHB has told them to that SCAR should be much lesser. So what could be the probably the reason for lesser capital adequacy ratio? If you simply go by the formula, it's tier 1 plus tier 2 divided by risk-weighted assets. So either the tier 1 should have been lesser, which means the provisioning should have been higher, or and the denominator as well, the risk-weighted assets might have been much more higher. So there is a doubt on the classification of some of the assets. That is, probably there's been a divergence in the asset quality. So that is one. So we need to follow up on this, what the management replies to NHB. So this will probably, we'll get to know in next couple of days when they actually do that. The next one is obviously we know that the numbers were not audited in next couple of days. So probably the management has just, and the auditors together, they've just bought time because the audited numbers will be out in next few days. July 22 is the date, if I remember correctly. And apart from that, the biggest question mark is that on some of the loans, there was no documentation. On loans worth about 20,000 crore rupees, there was no documentation. And as far as the wholesale loans are concerned, within that 34,000 odd crore rupees wholesale loans, about 16,000 odd crore rupees were the loans on which the checks were received, they were entered as receipts, but not later banked upon.
Who does that?
So exactly. So basically, that is a big question mark. So that clearly shows that probably there's some amount of stress on those loans. So we need to watch out for that when the audited numbers come out. So that is a big grey area. Other than that, there were intercorporate deposits as well. There was a huge spike in last 1 year. The management says they were mostly short-term in nature, etc. Some of them have been converted into secured loans. But there is a huge spike, and even for those intercorporate deposits, there are gaps in documentation. So we need to know all of that. So those are some of the concerns, which have come to the forefront. And it'll be interesting to see what the auditors finally say. And other than that, about some of the ongoing issues, they've been continuously defaulting. So defaults have continued, 48 crore rupees of defaults, on July 6 and July 8. And lastly, on their plans going ahead. So the company itself is saying that there are concerns regarding the going concern concept of the company, because if they don't get the funding from the banks, if they're not able to monetize, restructure the debt, etc., then there are concerns that the company may not even continue going forward. So the management itself is flagging that off to the investors. So that is very worrisome. About some of the other plans, they're saying that they're set to submit the resolution plan to the lenders. They're in advanced talks to figure out or identify a strategic investor, and the bank's intercreditor agreement will examine and firm up the terms of the resolution plan by July 25. So in the next few days, we have a lot to watch out for as far as DHFL is concerned.
Yeah, sure. And as Shefali said, for the management to say that the ability to raise funds, this is their statement, that the ability to raise funds was substantially impaired and the business has been brought to a standstill with there being minimal or virtually no disbursements. That just tells you the state of affairs that DHFL is in. And you could talk about whether this ship will be saved or no is one question, but from an equity value, you could almost argue that it's very difficult to see any kind of reasonable equity value at the current point of time. At least I would reckon that's what the financial market would take it as. So it'll be a very interesting stock to monitor this morning. Shefali, thanks so much for putting all of that into perspective. Well, that is some bad news. We don't usually start off with a non-nifty name, but it is just such an important name that it needed to be done that. But let's get back to the bigger names, because the other one, which was very interesting, came out in Friday's session, was Infosys. It raised its revenue forecast for the full financial year, even as higher costs hurt margins and caused a decline in the profit in the June quarter. But how does the software exporter stack up against its biggest competition, TCS? Agam Wakili standing by with a scorecard. Agam, good morning. I remember couple of quarters ago, you were making this point that a lot of people question whether it's fair to compare the two because TCS seems to be in a league of its own. Yeah. This quarter, not that Infosys has come back into the TCS league, but it's turned around a few pages.
Yeah, there are actually a bunch of variables which have actually turned out to be very well for Infosys this particular quarter, and hence comparable. More importantly, this particular quarter, Infosys wins hands down in front of TCS, and that will show up as and when we go through the various numbers. Let's start off with your constant currency growth. And while we do have 2.3% growth for TCS, which is of course below what Infosys has come up with, around 2.8%, TCS's growth was below expectations and Infosys was ahead. So it's a mark on both these places where Infosys comes ahead, which is why I've given a score to Infosys in this particular area. Hence, it's 0 for TCS and 1 for Infosys. But let's move on and talk about your outlook. This was perhaps a surprise for many because not a lot of people were expecting Infosys to increase their guidance, but they have done so. So from 7.5% to about 8.5% and 10 as far as FY20 is concerned, as against TCS maintaining their target of double-digit growth that they have seen. Of course, margins, TCS is that aspirational margins target of 26 to 28%. We haven't really seen that except for one-off quarter here and there. But Infosys, of course, continues to maintain that. That, of course, is a positive. But given the fact that Infosys has also hiked its revenue growth guidance, and now it comes to 10% on the higher end, which is also double digit. Well, it's literally competing with TCS in terms of growth. And that, of course, is a positive, which is why, well, it's another goal for Infosys in this case, which takes the score to 0-2. And moving on, as far as your margins are concerned, both companies saw a dip of around 90 basis points. And this was, again, on expected lines. So it's kind of a draw in between as far as this particular aspect is concerned. And both companies were plagued with the same issues when it comes to higher visa costs, or for that matter, the Indian rupee. Of course, we have to take into consideration the wages, which were also, the wage hikes, which also took place as far as this quarter is concerned. Moving on. This is as far as your digital sales are concerned. And again, both of these companies are going shoulder to shoulder, and with 42% growth for both companies. So I gave it a draw for both these two. In terms of, your revenue contribution, it's largely the same, about one third. So again, it's a draw. But perhaps the final, variable that we can consider is the financial services sector. Now, a third of your revenues come for both the companies come from this particular sector. While TCS saw a decline, Infosys actually saw a gain on a quarter-on-quarter basis in rupee terms, and that's of course a positive, which also means that Infosys is clearly doing something which is clients, and of course a set of clients where TCS has been a little bit of a lag, and that's the reason why I've given Infosys another score, which takes the total score for now, at least in terms of the main variables, to 0 for TCS and 3 for Infosys. So Infosys is a clear winner as far as the first quarter is concerned.
Okay, and Infosys also changed its capital allocation policy this year, Agam. Yeah. There's a big announcement to that effect in the results.
Right. Well, Neeraj, I would actually include this in the football match between the two, but because we can't really compare the capital allocation policy to TCS, yes, Infosys has increased its capital allocation policy to shareholders cumulatively over 5 years to 85% of the free cash flows, as against 70% earlier. Of course, to very quickly talk about TCS, they determine more to do with what cash they have, and in the last financial year, they stood at around 110%. But again, because capital allocation policies are different for all companies, I didn't put this as a comparison. But this, of course, is another factor which will improve sentiment for Infosys, and that's the reason why we've seen some price target hikes as well as an improvement in ratings.
Wondering, Agam, have most brokerages come out and given a thumbs up to Infosys, because the ADR indicated that there will be some traction today?
Yes, they certainly have. As I was saying, that we have seen in some cases an improvement in ratings, as well as targets will increase as well.
Okay. Thanks, Agam, for that. Just wondering, off the cuff, why a football match? I thought you would have taken inspiration from either tennis or cricket as opposed to football.
So this is more of a tradition. I've always done, a score in terms of football. It's always easier to, put it that way. Even though I would have loved to talk about tennis and cricket today.
Okay, fair call, Agam. Thanks so much for putting that into perspective. That's Agam Vakil. He quizzed Infosys on the numbers in Friday's session from their office as well, and now bringing us up to speed with what the comparison has been between TCS as well as Infosys. On to another set of earnings that came out over the weekend. Avenue Supermarts posted a strong set of numbers in the first quarter. The D-Mart operator capitalized on its new scheme called the Everyday Row Price Model. Yatin Motas here with the details. Yatin, good morning. Just when everybody was talking about whether it's going to be curtains for D-Mart, they come out with an exceptional quarter.
Yeah, exceptional quarter, Neeraj, and if you look at the revenue performance as well as the margin performance, both have been very strong. In fact, if you look at the revenue growth for D-Mart, it has been at a strong 27% for the first quarter. And more importantly, despite 27% kind of a growth pressure on overall marketplace in terms of competition, they have been able to improve their absolute EBITDA by 41%. And if you look at the margins also, given the fact that the EBITDA growth has been strong, came in at 10.3% versus a level of 9.2% The street was anticipating a margin figure of anywhere between 8.5% to 9%. Clearly, this margin figure is almost a 20% kind of a beat to the marketplace. Profit growth also coming in healthy at 32%. More importantly, Neeraj, if you look at the brokerages at this point in time, they estimate that the same-store sales growth for Avenue Supermarts would be around 11 to 12%, and that is quite strong. We haven't seen such a strong same-store sales growth, given the fact that the store addition were not that great last quarter. Of course, last quarter's incomplete projects or incomplete stores got added this quarter, and that is the reason why we had a good store addition for the quarter gone by. In fact, now as we speak, the total store count for DMart is around 184 stores. But clearly, if you look at brokerages like Morgan Stanley, they do believe it's a strong quarter. However, last year same period there was 100 basis points margin improvement. But in the coming 3 quarters, which is basically the last 3 quarters, we couldn't see substantial amount of margin improvement. And DMart continuously disappointed the street with margin contraction. Now, given the fact that the margins have been stronger, Morgan Stanley is questioning the sustainability of margins, and if margins were to sustain, then probably brokerages will look at some kind of earning revision, some kind of upgrade. But as of now, brokerages, including Morgan Stanley, do believe that of course the results are quite healthy. However, the sustainability of margin is something that they'll be watching out for. And in fact, if you look at the analyst recommendation page on Bloomberg, still there are a whole host of brokerages which are negative or have a sell. Most of them have a sell on that one, given the fact that the valuations are stretched. But if the margin trajectory were to improve or were to be around that 9.5, 10.5 kind of range, then probably brokerages would have been happy even to give those valuations that DMart is trading at.
Yeah, but I thought it was an important quarter because it needed to perform for the last 2-3 quarters. As you rightly said, the margin trajectory not quite the best. I think it needed to put up a good show this quarter, considering that after getting punished, it's also bounced back. So somewhere the stock knew that it needed the company to perform for it to sustain. Otherwise, it would have been a pretty big squib for the stock. Yeah, damn squib for the stock, and we probably hope that these margins sustain because the valuation that the company is trading at, the kind of margin performance that they gave last year same quarter was good, but then it came off. So it shouldn't happen. We hope it doesn't come off. Probably with the store additions and the new management strategy, we could have some good traction coming forward. Okay. Yeah, then thanks so much for putting that into perspective. That's Avenue Supermarts for you. A very important quarter and a well-tracked stock, therefore important. Must just add though that that store addition, that number that you're speaking about, which is looking healthy, also because of some bit of spillover from the uncompleted Q4 as well. So just keep that at the back of your mind, but should react positively today. Okay, moving on. The government plans to list at least 10 public sector companies in this fiscal, and that's not all. The plan is to bring down stake in all the listed entities to a combined total of 51% over the next 1 year. Nikunj Ohri has the details on exactly what's been worked on by the Department of Investment and Public Asset Management.
The government has a strategy in place to meet its ambitious divestment target of a little over 1 lakh crore rupees in the current financial year, and according to the plan of the government, in the next 1 year, the government is going to list a number of companies on the exchanges. It's going to go ahead with the strategic disinvestment it had planned and which has been taking some time now. It's also going to redefine its equity holding structure and also introduce a new ETF or exchange traded fund especially for financial sector companies and divest the government stake in these financial sector companies. As far as companies that are headed towards the exchanges, there are about 10 companies that have been planned by the government which it intends to list in the market in the current financial year. The government has already is already looking for book running lead managers for IPOs of 2 public sector companies, that is Railtel Corporation and THDC, which is Tehri Hydro Development Corporation, and 8 other companies that it plans to list on the exchanges this year. As far as strategic disinvestment is concerned, we've seen a delay when it comes to strategic disinvestment. We've seen Air India's divestment getting delayed, and several other companies which have been delayed because some of the other reasons. Now the government plans to go ahead with strategic disinvestment and has shortlisted about 14 companies which are small and mid-sized companies, which is going to go ahead in this divestment. And Air India, as far as Air India is concerned, the government has said that it's also going to divest Air India in this financial year. Besides this, the government has also come up with a new definition of government's holding in public sector companies. It intends to bring its stake below 51% or up to 51%, in which the government's as well as government-owned institutions' stake is concerned. So we'll see government's holding coming to 51% in many of the companies, and also below 51% on a case-to-case basis, as the government has said, and it has also been informed by the finance minister in the union budget. There's also one more thing that the government is planning to do now. It aims to bring down the minimum public shareholding in public sector companies now, as the finance secretary recently said that various government-owned departments ask or seek extensions to meet the 25% mandatory 25% public shareholding norm, and now the government has made it a point that it is going to stick to the minimum public shareholding norm of 25%. And as of now, there are about 16 companies in which the government owns more than 75% stake, and some of these companies are ITI, Hindustan Aeronautics, Hudco, Ircon, Rail Vikas Nigam, in which the government will have to bring down its shareholding below 75%, so that the minimum public shareholding norm as mandated by SEBI is followed. And lastly, the government's ambitious project, if I may call it, the exchange traded fund, which has helped the government in garnering a huge amount as far as divestment is concerned. The government plans to come out with a further fund offer of CPSE ETF, through which it will divest its stake in various public sector companies, and also come up with a financial sector ETF, which will have which will help the government in divesting its stake in financial sector companies.
Well, and like Nikunj mentioned, it's not going to be an easy task for the government to find takers for so much equity. Now, the 4 or 5 questions that come when you look at such grandiose plans. First, is the market conducive after this whole surcharge and the FPI, the taxes on not just FPIs but across, but higher taxes for the FPI community? Is the market conducive for taking so much paper from either the government side or the private side? We've seen all investment bankers talk about how the private papers too are taking a step back and reassessing as to what should their launch date be for their IPOs. In such a scenario, would there be so much appetite for the government, or is the market conducive? And then, of course, can we observe so much paper coming in such a short span of time? Because remember, it is not just the government paper that will come in. What if the norms of public shareholding moving up from 25% to 35% is accepted? Then we have serious paper coming into the market. Can we actually see so much of paper coming in the first place? A third point that I think needs to be answered before we take a call on this is that these divestment numbers that we're talking about, will they be scattered over a longer period? Will they get bunched up? I mean, would we see this happen over the course of a spread out 12 months, or will the government try and find a good conducive time, and therefore a bunch of that happens only in the last quarter, as we saw happen in the previous year as well, wherein at the fag end you did a couple of things and try and fit that whole number in? So that's a very important question that needs to be answered. I spoke about tax changes. The big thing that Category 3 AIF CEOs and CIOs tell me is that they were big investors into that whole divestment CPSE vehicles. Now with this added tax, wherein their tax incidence goes up from 35 to 42%, will Category 3 AIFs invest post these taxation changes, because they might find greener pastures elsewhere? So that's a big thing, because the government had a ready kitty from Category 3 AIFs as well, putting in money out here. Now that kitty might be rethinking, will there be enough appetite from that category of players as well? And largely the most important thing, typically in the past, when the depth of the Indian market was not so high as it is right now, large IPOs or large primary market offerings used to pull money away from the secondary markets. Now, if things go well and if the markets are conducive, we'll have IPOs, we'll have QIPs as Axis Bank and some other banks have shown. We'll have this government divestment. And again, I come back to the point, if the public shareholding norms are accepted and if some companies choose to do that exercise, will so much of large-scale offering weigh in on the secondary markets? And will that be a spiral which dampens the secondary market and therefore these companies can't come out with the paper in the first place? So there are few very important questions that I think the government and everybody who is planning to come out with fundraising plans will need to answer before they go out and announce their fundraising plans. So this may not be a done deal as yet. That's all that we have on First Word today, but lots more lined up on In Open. We talk about some of these points with UR Bhatt of Dalton Capital Advisors. He joins us a bit later on in the show. A special conversation with the chairman of BEML, Mr. DK Hota, on the order book picture, the government stake in the company and more. And then we decode the June quarter earnings for GNA Axle with whole-time director Kulwin Sira. The stock was up 14% in Friday's session. It promises to be an interesting conversation. But after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Quint Live.